Another decision that management may have is whether to drop a product line or not. Now, this is a decision whether or not to continue a product line or a segment. Do I keep making this or do I get rid of it? Is it not worth it for my company? The decision is based on whether or not the product's revenue exceeds the cost directly traceable to the product, including direct fixed cost. This is really important because sometimes it may look like you need to get rid of it, but when you actually do the decision-making analysis, you realize it actually has an alternative effect if you actually get rid of it. Some relevant information that you need to keep up with when making this decision is all direct costs associated with the product or the segment. You want to make sure that you're looking at and using all the direct costs when it comes to the product or the segment. This includes variable costs. It also includes direct avoidable fixed costs, and that's very important. So let's look at an example of this one. Assume a company produces two sizes of products, small and large. A recent segment in income statement is shown below. Since the small product line is producing a net loss, as we can see, it's got a negative 4,000, the company is thinking about dropping it. Should they? So let's go through this and kind of play the scenario out to see if they were to drop it, what would it actually do to the net income? So if I got rid of the small, because right now, if I add the small and the large, the total is 800,000. If I got rid of the small, then all I would have left is the 4,800. So we'll move that over. Same thing with the COGS. If I got rid of small, I would get rid of the 240,000, which means I'm left with 320,000, which means it gives me a contribution margin of 160,000. So again, this is only leaving what's left of the large. Now let's look at the fixed costs. The direct fixed costs, again, are traceable to each product. So if I got rid of the small, then naturally the direct fixed cost of the small would go with it. So I can get rid of the 20,000, which means I'm going to be left with 40,000. However, the common fixed cost is a fixed cost that it doesn't matter if I get rid of the small or if I don't get rid of small, I'm still going to have to pay that. So if I get rid of small, I don't actually get rid of the 64,000. I actually push the 64,000 over to the large, making it 164,000, which then leaves me with a net fixed cost of 204, total fixed cost. Then leaving me, if I do the calculations, a net income or net loss in this situation of negative 44,000. So right now, yes, small is only producing a negative $4,000 loss. However, if I get rid of it, it would actually yield a negative loss in my total business of negative 44,000. So in this situation, we would not want to drop it. It's paying enough even though it looks bad on the income statement.